Stephen Lee, will you please take a minute to give us a brief introduction on yourself?
Oh, good morning, everyone. So my name is Stephen. I work at Celestia Financial as a financial broker. What we help with individuals is either you look at investing, insurance purposes, or simply just looking for a simple way to invest your money in. That's what we do.
Hi, everybody. My name is Araceli, and I'm a transition financial specialist. I'm an independent insurance broker, and I work mostly with professional women that are going through transition, whether it's divorce or they are being separated or they're going through any changes in their lives, as well as people that they are going into retirement or they are going into another transition like getting married. So that's it.
All right. Now on to the questions. Our first question today comes from Ivan from Hamilton, who wants to know, what research conduct gives recent market turmoil?
So we look at the fundamentals of the economics. So you look at total economic transactions. You're looking at inflation. You're looking at just thinking for a moment. Inflation. You're looking at economic growth. So when we take all of these into consideration, helping our clients avoid all the catastrophes in the markets, so we can take 2008 as an example. When the whole market crashed, everyone was losing money. We helped individuals avoid that crash, and at the end of the year, we helped them return over 30%.
Araceli, your intake on it? Your take on it? What research you conduct give recent market turmoil?
Well, the most important thing that you need to do is figure out what your client wants to do, because every client is different. So, and so you need to evaluate what their time horizon is. So it's looking at the market is something that we also do, but I think it's knowing your client and what they want to accomplish is very, very important. So that's what we concentrate on.
Thank you very much. Moving on to the next question. Tyler from Facebook writes in, what is the difference between term and permanent insurance, and what is the best for his current situation?
So that really depends. When you're looking at term, it's a limited period. An example, if you were having a mortgage and you needed coverage in case the person passed away, they'd have to pay for the mortgage, they would use term insurance as one option. If they're looking to say hold their house for, you could say, till they're passed away, then having permanent insurance can help, because once you have capital gains on the house, then life insurance can essentially pay for it.
Thank you. Araceli?
Well, those two different insurances are very different, and they have very different uses. So, and it depends also on the economic situation of the client, how long they need the insurance for. Permanent insurance is usually used to retain wealth. And the term insurance we usually use to, as Stephen said, for a period of time to protect something like a mortgage, something that you may want to do income protection as well. So that is the two major differences. So, but it also depends on the client.
Very informative information. Thank you both. Continuing on to Cynthia from Bradford. What is your investment philosophy?
That's a good question. So our investment philosophy is really a very conservative approach. We're not going into the markets, risking it all, gambling for it. Because when you look at, as example with using fundamental economics, in the recent March 2020, we actually, 1 week prior to the crash, we actually had moved all our funds out of the market into equivalent to daily interest. And what this has caused is we've prevented a massive loss of a peak of 30% for our clients.
Thank you very much. Araceli, your take?
Yeah, what I normally use is different portfolios already preset, and those portfolios also are according to your age, your time horizon for investing. And the managers that are taking care of these investments, they will do the same thing, similar. I don't know if your company does it individually, or this company does it automatically. And they look at the markets, and the same thing. They have certain percentages that they need to meet, and they will move funds around so the portfolio does, obviously it will mimic the market, but it will be according to what that portfolio is to do, right?
Emily from Instagram, can I get a refund on my insurance or disability if I decide to cancel it?
So based on the different insurance products, they have you could say once you've signed on the product, you've met with the life insurance agent, signed the dotted line, you have a very limited period for life insurance. It's 30 days, as an example, and that's to say, okay, sorry, not 30 days, 10 days. So given that 10-day period, you have time to think, look over it, assess, is this for you, and decide if you want a full refund.
Well, for when it comes down to refunds, right? You're right. When it comes down to the, you have 10 days to evaluate it, but obviously you will not be covered after that. However, for some policies, you have something that is called return on premium, and that is an addition that you can add to the policy. Mostly, it's in permanent insurance, and that will allow you to have your premiums back if you don't use the policy, sometimes 10, 15, or 20 years, depending on what you choose. So that would be something and a strategy that you want to use, but it also depends on your age and the type of coverage that you're getting.
Okay. Alicia from Scarborough writes in, are you fiduciary on your recommendations?
So as all audiences, in case they don't know what fiduciary means, it is simply that we as the advisors looked over your interests above ours. So meaning that if we're advising or offering any products, we're looking based on your situation and catering the product to you, essentially how a doctor would assess their patient before providing medications.
That's correct. I've heard this a lot in many websites that I said, oh, ask your advisor if it's fiduciary. The question is actually irrelevant because we're bound when we get licenses to be fiduciary. So if your advisor has been in business for over 2 years, then they're doing the right thing for their clients. So that's what I would look for more than to ask them if they are fiduciary. I think that every professional that is in the financial services industry, they need to be. If they're not, believe me, they will not be in business for very long.
Thank you. Continuing. Mark from Brampton. What is the difference between the insurance I get from the bank to the insurance I get from your company?
So when you look at it from a banking standpoint, because banks are not insurance companies, meaning they have limited coverage options versus from insurance company products. And one example, if you gave, let's say for a life insurance policy, you can get a term from a bank, but within the actual insurance companies, you can get term, as we mentioned before, or permanent insurance.
Yeah, one of the biggest sellers from the bank is mortgage insurance. So when you go and get your insurance, they offer mortgage insurance. And what happens with that product is the product is completely different. Most people think that it is life insurance, which it is, but the beneficiary is not your designated person. It is the bank. So whatever the mortgage amount is owed at the time of you passing, that's what the bank will pay to themselves. So they want to make sure that they get paid first. So we always, as advisors, recommend that you have your own policy because that is, you can port it. You know, in most cases, in a mortgage, you're going to have a period of 5 years. And guess what? The majority of us are looking for to get a better rate, and most likely you're going to be changing from one bank to another bank or another institution. And what happens at that time, that insurance that you got with the initial company, it's done. You no longer have it. You have to have the insurance while you have the insurance with that specific company. And at that time, obviously, you're going to be older, right? You don't know if you may qualify for insurance anymore. But if you do have your individual policy that you can get through one of the independent brokers, then you have it with you, and you don't have to requalify for it. So that is kind of like the major difference.
Okay, very informative. Thank you. If you're interested in knowing more about the insurance from their companies, please connect with Stephen Lee or Araceli Hernandez. Moving on to our next question. Cara from Texas. Does your company invest in funds or product?
So we just want to make it straight. We don't drink our own Kool-Aid. So meaning we offer products that are offered by all sorts of insurance companies. For example, we dealer over 20 plus insurance companies. So we take all the very best of their products and trim it down and offer our clients a choice based on their situations.
That's correct. One of the things that I use the most is something that is called segregated funds. And segregated funds, they have a double use. I use them a lot with my clients that are over 50 because it also provides some state protection. What that means is that your probate, when it goes into probate, you're not going to be paying that tax when it comes down that time. So the assets will pass directly into your beneficiary. So that is one of the major advantages of that. But it also depends on the client. What is their time horizon and what is their strategy? So.
And that pertains to both Canada and the U.S.?
No, we actually, I am licensed here in Ontario, Canada. I don't know if Stephen is in other ones, but all of this information is for Canadian, and also it's for Ontario. I don't know if there's other brokers that they have a little bit different rules in other provinces.
Okay. Paul from Mississauga, what is the difference between buying a stock or mutual segregated funds?
So if we look at it from a simple point, when you buy a stock, you're really buying a company, versus when you look at mutual or segregated fund, Araceli mentioned, you're really buying a basket of companies. It could be either from a sector or the whole broad market, as everybody looks at from the S&P 500 or the Dow Jones. What it just really does is you're diversifying your investments. So this way you're avoiding all the potential drops. If one company suddenly committed a scandal and dropped to nothing, or even worse, bankruptcy, you're going to lose all that money, and that's going to hurt really bad.
Yeah, a lot of people, what they do is they like to look at the news, right? It depends also on what you want to do. If you like to do research and you have the time as well, then you can go into stocks. And that is, as Stephen said, is you're just buying one asset. So that specific company might be in the sector of maybe real estate or automotive and so on. So the market always fluctuates, and sometimes one market goes up when another goes down. And if you have a segregated fund portfolio, you have a diversification. You're buying many companies at one time, that it'll give you kind of a smooth ride. One of them is going to go down, the other one is going to go up, and at the end you're going to be up most likely, right? So, but most people think that stocks are best. In my opinion, it's a little bit of a gambling situation, right? But it all depends on your risk tolerance. So it depends on what you want to do, because now there's a lot of options online. The banks are giving you a ton of opportunity to invest by yourself. But the same, if you don't do the research, and most likely the research that you do, you'll get it from the news. And if it is in the news, it's already old news. So you already missed the boat, right? So that is the kind of thing that most people don't understand. And they just, oh yeah, this stock is doing really well, right? But it's already past the gaining point, right? So it depends. I will say that if you want something that is smooth and that is going to give you certain amount of return for you to manage, and you're going to be investing on a regular basis, probably segregated funds or mutual funds would be the best option.
Thank you both for responding. Andrew from Bumble writes, what happens to my investment if you're gone?
So luckily at Celestia Financial, if let's say, unfortunately, I had passed away, the company itself will manage your funds, and of course we take a very conservative approach. So when you're looking at it, we're not going to say, if I'm gone suddenly, nobody's there to manage.
That's right. Yeah.
And the best part of it, we have a team that works with us, so your funds are invested in the same approach as I'm approaching it, plus a little more.
Yeah, that is exactly the same. So we are advisors and we are representing companies that have been sometimes around for over 100 years. So your investment is safe, whether we're here or not. Somebody in the same, in my company, will take over your investment and will continue on with, the plan that you had originally. So this bee really likes us, huh?
It's looking to invest.
Looking to invest. Grab it.
And our final question. Sandeep from Facebook. What is a living benefit?
So that's a really, you could say, sketchy, well, not so much sketchy, more of a tricky question, because depending on which end of the insurance industry you look at, it means different things. So one simple one in Canada, let's say in living benefits, you're seeing, okay, let's say you're somebody who's like, well, I can't take care of myself. I can't get up in bed. I can't go to the toilet. I need some help, such as a nurse. So the living benefit provides a lump, you could say a daily amount maximum to help you through those days and pay for your expenses, such as food, as an example, services for moving around. Of course, it doesn't pay unlimited. There's always a set amount per day or even per month, so it depends what you're looking for in the coverage.
For when it comes down to it, I think this is becoming more and more of a question for people, because most likely when you're buying insurance, you're buying life insurance. It provides a death benefit. However, now there's other policies like critical illness insurance or disability insurance. Those policies actually will pay you when you're alive. So critical illness insurance will pay you when you get a critical illness. And if you are diagnosed, then they will give you and pay you a lump sum so you can take care of yourself, whether it's medication or you need a special treatment, or maybe you just want to go to Disneyland. I don't know, something like that, right? So they don't tell you what you can do with the money, but it's there for you to help you going through. Maybe your spouse needs to take some time off to take care of yourself, and those funds will serve to, for the day-to-day things. Disability insurance is to cover you in the case you have you're not able to work and get money. So those are basically the two major policies that will pay a living benefit.
Thank you very much for joining us today. I'm Melissa Raymond, your Mississauga City Leader from this great city. Please join us every Wednesday night at 8:30 p.m. for Investing 2021 with myself and Stephen Lee. For more information, you can go to our website at www.thisgreatcity.com. Look forward to seeing you all there.
Well, that's all right.